Hi investors, Nick Garner here from InvestMore, and today we're going to do a bit of a dive into answering a question, which is now we've got lots of inflation, is it wise to invest in buy-to-let property? And it's a question I want to answer for my own kind of peace of mind, and therefore I've done a deep dive into this and I've played around with a lot of numbers and made a bunch of assumptions, which I'm going to talk you through. And you decide what you decide upon. But I kind of know where I'm going with all this, and maybe you'll agree, maybe you won't. I don't know. We'll find out if you stick with me through the video. All right, let's jump into it. Now, the very first thing is it's worth understanding that there are property cycles and that we are probably in the end of a cycle at the moment. And the reason I believe this is because we've got affordability data going back to 1845, and each peak represents where house prices were less affordable, which means market boom at the end of a market cycle. And you can see the red arrows show that. And we're into cycle number 9, but there was a little mini peak in the middle or beginning of World War One, and then obviously prices dropped a lot by the end of that war. But oddly enough, Second World War, you can see prices dropping, and then suddenly after the war, a huge spike. And we'll talk about the 1940s fairly shortly. So the main point about markets is they work in cycles, and it typically looks like this. And this is what they also look like if you look at them in like kind of normalized graph form. And you can see in a boom phase, you have this precipitous rise and then a crash, and then it goes flat for a very long time, and then you get a recovery and then you go rise. Now, London is is odd because it went through a counter-cyclical cycle. So in other words, there was a crash, and then there was a huge influx of money between 2012, say 2010 and 2013 thereabouts, and the London market rose whilst everyone went flat. Now, the other thing to think about is inflation and how that affects everything. So, if I have something that is, if I have cash, £100,000 in cash, and I have 4 years or 3 years of inflation, then my £100,000 might be worth £10,000 less in purchasing power terms. In other words, I can buy a certain amount of stuff with my money today. In 5 years' time, with inflation, I can't buy as much stuff. That's broadly the way that works. And the real killer in property is not so much the actual crash part, although that's a big, big, big issue for owner occupiers if they're very indebted. It's more just the inflation, just nibbling away at the value of the property when in theory that money could have been used somewhere else. And we'll get into more of that later. And here we have another way of looking at property peaks, and this is where we have mortgage payments as a percentage of take-home pay, and this is 1990 and 2008, and now we're entering another period now where mortgages are increasing as a proportion of property prices, and that'll be due to things like higher interest rates and cost of living going up and cost of property going up. But there will always be a reset because this kind of thing isn't sustainable. And the next thing is, what about interest rates? And I've talked about this a lot, but broadly, here's a chart that I find very helpful. And it looks at inflation and interest rates over the last century. And you can see in the 70s, a lot of inflation, a lot of high interest rates. And in the 40s, a lot of inflation, very low interest rates. So then the question is, how does that work? Why the miscorrelation? And the answer is public debt. Whenever governments load up on public debt, they have a problem, which is debt maintenance. So if they raise interest rates for the country to quell inflation, i.e., soak up all that extra money in repayment costs, they also have to pay out more money in interest payments themselves. So the interest rates they pay are tied in with the UK base rate, and it's the same with more or less most countries. And if you have a huge amount of government debt, then doubling the rate of interest, for example, means you double the UK debt maintenance costs, which is huge, and therefore they have to raise taxes, and therefore it suppresses the economy because people don't want to spend, they're just trying to survive, and so on. You get into a negative loop. So therefore, uh, it's very important to think about that backdrop. And my view is we are in a period very similar to the 40s with a lot of reorganization. So we've had COVID, equivalent to the war, Second World War. We've had huge disruptions on supply side chains. So a lot of supply, uh, lack of supply, which drives inflation. And in the UK, we've got several issues which are extra special for us. So obviously, we've got onshoring again. So that's going to be a disruption. We've got Brexit, we've got Brexit, which requires a huge reorganization of our society. Then we've got the green agenda, i.e., cutting back carbon emissions, and that's going to cost a lot of money, going from petrol to electric, basically, and from gas to electric, which is a huge cost and a huge infrastructural cost. Then we have the end of the long-term debt cycle. So the last debt cycle began around 1945, and these debt cycles are typically 80 years long. So there's just lots of stuff going on that means trouble. And it's likely that interest rates will remain low because governments, certainly this government, has to. So then the next question is, well, how do I validate that? Well, okay, here we go. A good way of looking at it is fixed rate interest mortgages. Now, this is just home mortgages. There'll be other mortgages, but the point about this is the reason I'm showing you this is because all mortgage finance from the bank's side is sourced from the money markets, I guess, and there's a price that they can buy money at, and then they resell money at a margin, at a profit, and that's what happens. And so therefore, this is a very good indicator as to what's going on in terms of like how the banks and how financial people see the future with interest rates. And here's the 2-year rate, 2.54 fixed, fine. So what about 5 years? And it turns out that they kind of see it roughly the same, 2.5%. So somebody, if you think about how this works, some institutions or people in general, organizations are betting that interest rates will remain low. So if interest rates really go up high, then they effectively lose. So they're banking on interest rates remaining low. What about 10-year? Well, it's 3%, half a percent higher than the 2-year fixed. What that tells me is that long term, people think that interest rates are going to remain low, and I buy into that in a big way, based on what I've seen with the macro story and how governments can't raise interest rates too much. Otherwise, it gets very expensive. Now, that's that. With that in mind, let's get into some calculations. And I built this spreadsheet. There's quite a lot of bits to it, but here's my inflation calculator, and I assume that we will have an average of 7% inflation over time. Now that means that in 4 years we'll have cumulative inflation of 26% or thereabouts. That varies, but I'm just saying as an example, I think that's a reasonable number. Now, if you had £200,000 in cash, then you're likely to lose £53,000 of your purchasing power. So think of it like this. Today, you can buy 2 very fancy cars for £200,000. In 4 years' time, after the property crash and the market has settled down and so on, I would say you could buy 1.5 fancy cars in today's money. So that's how that works. And what we're interested in then is like, well, how does it all play out with property purchasing? So I've got £200,000. That means, in theory, if you assume that cash outlay for a property is roughly 36% of the property price, which it is typically, then for £556,000 then I can get £556,000 in real estate for my £200,000 outlay. And so my calculations are based on a total of 556,000 in overall real estate holdings, roughly speaking. Now, let's say that from here on to the peak of the market, so this period here, here we go, this thing here, to peak of market, let's say we buy well and we're somewhere around here, which I think we are, and therefore there's another 40,000 in it, and say another 35%. Now, we have a lot of tech that we use for identifying areas with a lot of capital growth. So for your average Joe on the street, as it were, they may not pick it as well as we might, but I'm confident that we could hit 35% house price inflation for till market peak. But anyway, that would be like 10% a year, and that's just nominal. So in other words, the property keeps going up. That doesn't factor in inflation. And then there's a 12% crash, and that's typical for what I see. Some areas are 6%, some are 20, but the areas that I like that we're picking out for our clients, they're typically around 6 to 14%, that kind of thing. So 12% seems like an average number that's reasonable to go with. And therefore, this portfolio, you got your 200,000 and then you got your portfolio worth 556 because you've borrowed against that and you've got 75% loan to value and so on. It drops 90,000. So therefore, your total profit and loss, assuming this scenario that the markets go up and then they go down, you're now nominally speaking up £104,000, even though the market's crashed, because you got in early enough. But you've got to get in early enough. That's the trick. Now, there is inflation. So let's say that in today's money, in real terms, you're up £76,000. So that's great. If you buy really late in the market, then you would lose £90,000 and you therefore would be £90,000 down on your 200,000, which means you're left with 110 because the market crashed on you. And then you just have to wait many years. So typically after a crash, you're going to have to wait maybe 8 to 10 years. But if you're sensible, you will have made sure that you get a decent net cash return. So at least you got an income coming out of it. And the good news is your income will rise in line with inflation because rents do that, which is lovely. And as you see, if you're sensible and you fix your interest rates, then you're all good. You've got consistent outgoings, low interest rates, rising rent. What's not to love? It's all good. So you got all that, and that. So there's a couple of scenarios. One is you buy at the wrong time, you lose 90 grand. You buy at the right time, you gain 76 grand in real terms. Then we're into the next thing, which is we've done this, the cash outlay. So the as I said earlier, if you just sit on the cash and do nothing with it, then you lose about a quarter of it to inflation. So you either gain roughly a third or more because you invested at the right time with the right property, or you lose a quarter. It's kind of a big gap. Now the next thing is the mortgage, because there's more to it than just the price of the house. There's also the loss of value in the mortgage, and this is a very important thing to look at. There's two ways of looking at this. One is you're an owner occupier. If you get the timing right as an owner occupier, you will do incredibly well, assuming interest rates remain low. You'll be at a high loan to value. So you got a big old loan. Now I'm going to change this to £200,000. So I'm just going to change it back. for this. I'll change it. Whatever. But the point is that what happens is that over time, inflation eats away at the value of the mortgage. What that means is that if you have 27% inflation, then the true value of the mortgage in today's purchasing power declines by £47,000. And if you're an owner occupier, your income goes up in line with inflation because that's how those things work. And therefore, you are in a much better position in these years to come because of that. And that mortgage gets smaller and smaller relative to your income, which is really good news for you. Now, if you're a buy-to-let investor, then it's the same kind of story, but it's slightly different because your mortgage isn't anchored against your, well, it is kind of. So there's a few variables to this, but I haven't gone down the rabbit hole so deep because I don't want to spend hours at this boring you. But in short, when you get inflation, you get rent inflation if you buy in the right area. So the cost of debt maintenance, assuming it's a fixed interest rate mortgage, the cost of debt maintenance gradually goes down over time, if that makes sense. So in other words, if you pay £500 today, but you have 25% inflation, then that, and you have rent inflation 20. So in other words, your rent goes up 25%, then the cost of that mortgage maintenance goes down 25%, roughly speaking, in line with the extra rent you get in. So I get more rent in, but my monthly mortgage cost remains the same. Therefore, proportionately, my overheads are less and less and less. So that's that story, which I didn't go into on the spreadsheet, but I just wanted to talk about the capital actually, because this is really interesting. The higher the rate of inflation, the better off you become broadly. And this assumes that you have fixed rate interest costs. So what happens is, and that the property goes up in value. So now we're entering towards a kind of end of the cycle, as it were. And if, for example, let's say there's no crash, let's say you get out before, in 4 years' time, there's no crash and everything's just fine. Well, then you make so much money because what happens is that you get all the inflation, you don't get increased interest charges because it's fixed for a long time, and then the mortgage goes down in value. The actual mortgage sum goes down in value by £129,000 because of the effects of inflation, i.e., the purchasing power just decreases. So what that means is that effectively you've got a mortgage of £370,000 equivalent in today's money. So in other words, inflation has eroded the value of this mortgage down massively. And that's great if the market never crashes, but the market is likely to crash because that's what it does. And you know, we're in here for the long haul. So it drops 16%. And then because of that, your mortgage effectively drops by £79,000 in purchasing power terms relative to the price of the house. So it's all about what it's relative to. In this case, it's relative to the price of the house. So you have two things. You've got your rent income and all that, which I talked about earlier. But in this case, you've got the house being worth more and the mortgage being proportionately worth less on this property. So it devalues. So again, I'm just trying to illustrate this through this notion of purchasing power, which can be a bit confusing. But the short of it is that over time you gain because your mortgage is worth less on your property, relatively speaking. And also you gain because your rent increases and therefore the debt maintenance costs decrease as a proportion of your income, which is wonderful. Again, inflation, thank you. So the upshot is with all of this, you lose money on your cash. You've sunk in 200 grand into this with all your property and all that. So you lose 53,000, but you gain on the the mortgage being worth proportionately less. So in other words, it's the debt has been pushed down a little bit, and therefore you gain 66 grand, and you gain 76,000 on your portfolio because your property is still worth more than you paid for it. Therefore, your total gain is £90,000, which is great. So, so the so the so to take this from the top very quickly, uh, you buy a bunch of property, it goes up, it goes down. You've got a net profit, which is 104 grand, but I want to adjust it for today's money. So I want to get a sense of what it's worth today. And that's that figure there, 76 grand. And again, the whole idea is you're forecasting 5 years' time, but you're thinking in today's money. So do I make money when factoring in inflation, or do I not make money? That's really the question. And this is how this answers it. And the answer is you make money in high inflationary periods if you invest in the right stuff. And in this case, this stuff happens to be buy-to-let property. Now, it could be something else, but very few other things have these characteristics. So that's a thing. So then, yes, you lose because your cash is stuck in this property. So, you lose 53,000 in purchasing power. Now, hypothetically, you could take that money and put it somewhere else and keep it in line with inflation. And that would be great. You keep your 200,000, but where you gain, so your money's stuck in property, you lose 53,000 to inflation, but the mortgage is worth 66 grand less and the property is worth 76 grand more, and thus you're winning overall. I hope that makes sense. There's a lot of concepts here which honestly I've grappled with, and I hope I've done my best with on this. But uh, yeah, as I say, I hope that's helpful, and thank you very much.